I'm Carol Knott-Teff with Remax Integrity, and today I have my good friend with me. This is Greg Bismeyer. Greg and I have been friends for over 30 years.
Yep.
And so here we are today because Greg is one of my go-to mortgage people. He has been in the mortgage business for ages.
Over 25 years.
Over 25 years. And he is an independent mortgage broker, which is very rare. When the mortgage industry shifted several years ago, he is one of the lone survivors of being able to be an independent mortgage. And so I'll just throw this in there. As a consumer, it offers you so much flexibility if you're trying to get a loan. And Greg can usually find an investor or a source for a loan that perhaps other people can't find.
Correct.
But he has all your traditional mortgages too.
In addition, that's right. Yeah.
So I highly recommend Greg, and that's why today a question has come up, and I brought him on because he will know the answers far better than I ever will. My field is real estate. His field is the money behind the real estate, the mortgage side, and that's two different levels of expertise. So we just want to talk about his expertise. Some people have been renting a home for ages and they're just kind of tired of doing that and want to take a leap into the home ownership market. Or they've gotten out of college, they've saved a little money for a down payment, but they're not necessarily a big earner. Let's say that they make $75,000 a year and they want to look at buying a house. Is that possible?
Carol, it is possible. Depends on the debt-to-income ratio, what their income is and what their current debts are. So if you take $75,000 a year income, probably the most that they will qualify for is probably without any debts on the credit report. This is just principal, interest, taxes, income, insurance on the mortgage payment is probably around $320,000. Without any debt showing on the credit report. If they have debts, car payment, credit card monthly payment, then that will decrease maybe to $300,000 to qualify or $290,000. It all depends. On a conventional loan, the maximum debt to income ratio that you can qualify for is 50%. So it cannot exceed 50%. Your current debts in relation to your gross income cannot exceed 50% on a conventional loan. On a FHA or VA, then there's more latitude. It can go over 50%.
But they have the additional mortgage insurance that's related to either FHA or VA.
That's right. They have the mortgage insurance.
And they might with conventional too, unless they put down 20%.
Unless they put down 20%, yeah. So it all hinges on what the debts show on the credit report. Okay. And what their monthly income currently is. Gross, not net, gross.
Okay, so let's assume that Mr. Buyer comes in, he makes $75,000 a year, and his debt is not off the charts. It's 35%, mm-hmm. Okay? So he would probably qualify fairly easy for a loan up to a house cost of $325,000, correct?
Yeah, that's 320. I was basing on 20%. That's $400,000 sales price.
Okay.
So if their debt to income ratio is 35%, they may very well qualify for $450,000, $475,000. So again, it just depends. Obviously everyone's different. And that's just that single bar. If they have a spouse that's going to be on the loan, you can add her income, but you have to also include their debts.
Right. And so sometimes what I've seen happen with you and even other lenders is together they might have $125,000, but yet one of the two in the spouse relationship has a lot of debt and the other one doesn't. And so it actually behooves them to only use one income. So therefore it reduces the total amount they can spend, but that debt to income doesn't keep them from buying a house.
Correct. Plus, maybe their spouse credit score is a lot worse than the husband's. So that would drive up the interest rate. So you may not want to have them on.
Right. Okay.
So that's another.
Okay. All right. So what debts that people might have are the easiest to knock off, so to speak? Let's say I have 20% to put down, but my debt to income is 55% and I don't qualify. So would you suggest, okay, let's put a smaller down payment, let's pay this off, and now you're good to go?
That's one option. Or whatever debts you have on the credit report, you may want to reduce that, which the balance, which will reduce the monthly payment. So they could do either or. So on a credit report, what helps your credit score is any balance in relation to the high credit limit that shows on the credit report will, in fact, help your score.
I'm not following that. Okay.
Okay. Well, the balance that's shown on the credit report, okay, on a particular, like a car loan.
Let's say I owe $8,500 on the car.
Okay. And the high credit limit, when you took that loan out, was, $25,000, $30,000, whatever that was. If it's less than 30%, it will help your score. If it's over 30%, it hurts your score.
Gotcha.
So that's one thing that you could chip down to reduce that monthly payment.
Okay.
That will help also.
I get, if you could get certain debts to less than 30%.
Yes.
Okay.
That helps your score.
Okay.
It used to be 50%, but now it's 30%.
Okay. So that brings up a question that actually happened to me recently. When a person sees, oh my goodness, I don't qualify, but I'm going to pay off some of this debt to improve my score, and then I'll qualify. So what approximately, I know it's a guess, is the time frame that these Experians and all these other credit people take to update a score?
It depends. It could take 30 days. It depends on the bureau.
Okay.
When it's whenever that trade line, if they pay it off or reduce it, and they send and it hits the credit report, the credit bureau, it's whenever it's reported.
Okay.
Could take 45 days. Some may take 60.
Okay.
So there's no magic number.
We can't say, okay, if I pay this off, then in 20 days I can put in a contract. You can't say that.
You can't
okay.
No.
Okay.
It's hard to say. It could be 25 days, could be 30 days. It just depends on when it hits that bureau.
Okay. Several years ago, you and I were doing a loan several years ago for a buyer, and they had debt, but they actually paid it off at closing. And is that even still
Yes.
a deal?
Yeah.
Okay.
Yep.
Can you explain that a little bit?
You could do that. Actually, I'm doing a loan closing next week where the borrower is sending me their most recent statements, credit cards, anything that shows on the credit report, and it will and then the title company at closing will get that paid off. So yes, you can still do that.
Okay.
And some people have to do that in order to qualify.
Right.
Like my borrower now has to do that in order to qualify.
Right.
So that's why we have to get the most recent statements with the current balance in order for the title company they will know what to pay off.
Okay. Okay. So I just want to throw this out there. My team happens to have a home listed for $290,000 with a pool in Montgomery County for sale right now. And so if you think, maybe I could buy and have a pool in my backyard, give us a shout. All that being said.
Just want to throw that in.
Yeah. So, Greg, what else would you advise? This probably applies more to first-time buyers or people who are getting back into the buying after they've had a financial debacle of some sort. So what would you advise to the general public about?
Well, once you start application for a loan, from that point on, and your credit reports run, from that point on, do not make any new purchases, whether it's a car or whatever. Don't open up any new credit. You just kind of stop at that time until it closes, because that could hurt you.
Okay.
Some, it could throw you out of not qualifying.
Okay. And don't you want to be careful about being able to prove the source of anything that does go into your account?
Oh, yeah. Yeah. You have to, any new deposits, or you don't want to start transferring money from one account to the other. That could cause a nightmare. You're going to have to document and do a paper trail on all of that.
Okay.
So yeah, it's don't make sure you don't start doing that, because investors, lenders, they don't like people moving during the loan process, moving money around.
Okay.
Just kind of leave it where it's at.
And I know this is a little bit off the topic we originally started with, but can you talk just a little bit about gift money?
Yeah, you can get a gift on a loan, and typically it needs to come from a relative. And in some cases, the gift can be either the down payment or help with closing costs, or all of it.
Okay.
Okay. And you just need to basically fill out a gift letter. It's a pretty easy process.
And the gift letter will say that you don't have to pay it back. It is a true gift.
It's a gift.
That's important in the letter.
Yeah, and it shows that on the letter.
Yes.
That there's no repayment.
And you can give them a draft of a letter that they have to do.
Yeah, I have a form.
Yes.
It's a one-page form. They just fill it out.
And whoever's gifting it signs
They
it.
gift it. If it's the dad, he fills it out and signs it. The borrower signs it, and that's pretty much it.
Okay. Okay. You are a lot more in the mortgage business right now than I am. What are you seeing out there? Are applications up, down, flat? What's happening?
Down. It's the interest rate right now, and this is ever since the war started, basically. The national interest rate is 6.5 to 6.6.
Okay.
That's where it's at. When the war hit, interest rates went up, gas prices went up, stock market went in the tank. So I think it's my belief that if the war ever ends, you will see a lot more activity in our industry, in the real estate industry. I think there's going to be more buyers. There's people out there looking at homes, but they're very hesitant on making any decisions.
They are. They're hesitant.
Very hesitant.
There are people who are buying, and there are some homes that are selling rather quickly, and there are others that are just sitting. That's a whole another video tube or reel or something. But you're right. That's exactly what I'm seeing, is that the market seems to be, I'm busy, and I'm very grateful that I'm busy, but it's a hard busy.
It's hard.
It's hard for the buyers. It's hard for the sellers, and the buyers are deserving to ask for a little bit right now, and the sellers are deserving to want a fair price for their houses. So it's a battle all the time.
And right now, this is nationally, 46% of sales contracts has seller contribution.
I did not know that.
46%. And so it's almost half. It's pretty common to ask for the buyer to ask for seller contributions. And in my opinion, it's advantageous for the buyer to pay list price or near list price and ask for seller contributions. It's better for them in the long run because they're not going to stay in that. The difference in payment, if they negotiate down $5,000 or $10,000 or whatever, the difference in payment is minimal.
Yeah. So
the buyers make out a lot better to ask for that seller contribution.
Okay. So I think that we're here to answer any questions that you might have. And I just want to share Greg's contact information with you. Should you need loan, need an advice, find out what you need to do to prepare to buy. Greg is almost 24/7, and
real close.
He is one of the best at answering his phone, replying to emails, and he stays on top of it. A lot of lenders are online these days, and you don't always get the personal touch. And if you're scrimping to make it happen, you may not make it. So you want someone who's on top of things, and he's well worth it. So Greg, share your phone number. It's GB Mortgage.
GB Mortgage, 936-271-4663.
And in case you can't remember, 936-271-HOME. That's what 4663 spells on the telephone dial. Oh, we don't have dials anymore. Thank you, Greg, for joining us.
Thank you,
if you
Carol.
have any questions about homes, buying, selling, and loans, we're here to help you. Call us and put us to work for you.